Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we are looking at BigBear.ai.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps the algorithm show this to more people who are trying to build smart wealth just like you.
So, we have a really fascinating case study on the desk today. It's a company that, if you just glanced at the headlines or the basic stock chart, you might be tempted to run for the hills.
Oh, for sure.
But when you actually peel back the layers,
Hmm?
and we are going to peel back a lot of them today, there's a massive strategic pivot happening that tells a completely different story. It's a classic example of why you can't judge a stock by a single quarterly headline.
I love a good counterintuitive story. I mean, those are usually where the real opportunities are hiding. But we have to be honest with everyone. Right off the bat, looking at the surface, things look a little rough, don't they?
They do.
I was going through their numbers for Q3 2025, and revenue was roughly $33 million. That's down about 20% from the year before. In Q2, down 18%. Usually, when I see a growth company shrinking like that, I assume something is fundamentally broken.
And that is exactly the trap. That's what a lot of retail investors fall into with a stock like this. They see red on the revenue line and just assume demand destruction.
Right, the customers are leaving.
Exactly. They see negative 20% and they just hit the sell button. But what we're seeing here isn't an accidental decline. It's a deliberate surgical removal of legacy contracts.
Surgical removal sounds painful, like they're cutting off a limb. What does that actually mean for the business?
Well, think of it like a high-end restaurant that decides to stop selling cheap, low-margin fast food to focus entirely on expensive steak dinners. For a few months, their total sales might drop, right?
Because they're not selling thousands of cheap burgers anymore.
Exactly. But the goal is to replace that volume with higher quality, higher margin revenue. Big Bear is shedding that old low-margin skin to grow a new layer focused entirely on government-grade AI.
So it's not that people don't want the product, it's that the company is actively choosing to stop selling the old stuff.
Precisely. They're in what we call a transition phase. And here's the tell. Here's how you know this is working. Despite that 20% revenue drop, management actually raised their full-year guidance for 2025.
Oh, wow.
Yeah, to between $125 and $140 million.
That's a key distinction. You don't raise forward guidance if you think the business is collapsing. You only do that if you see the new, better money coming in.
If the ship was sinking, they'd be lowering guidance and making excuses. Raising it tells us they have visibility on new contracts that are going to fill that hole, and then some.
Okay, let's unpack the financials a bit more, because I found something really weird in the Q3 report. I'm calling it the earnings paradox.
Right.
They posted an operating loss of nearly $22 million. So just running the business, they lost money. But then on the bottom line, the net income was positive $2.5 million.
Right.
How? How do you lose $20 million operating, but still end up profitable on paper?
It does look like accounting gymnastics at first glance, but it tells an important story. That positive net income, which is a huge swing from the $15 million loss the year before, is largely driven by non-operating items.
Okay, so not from selling stuff.
Right. It's from things like changes in the fair value of warrants, financial restructuring, but don't let that distract you. It shows the financial cleanup is working, even if the core operations are still in that investment phase. They're spending heavily on SG&A because they're gearing up for scale. They aren't trying to optimize for profit today.
It's like renovating a house. You're
Yep.
spending a fortune, so your bank account looks scary, but the value of the asset is going way up because you're putting in a new kitchen.
That is a perfect analogy. And speaking of the value of the asset, we have to talk about the balance sheet. This is the core of the bull case. And frankly, it's shocking for a company this size.
Yeah, this blew my mind. We are talking about a small cap company. Usually these growth AI companies are, running on fumes.
Constantly raising cash.
Yeah, constantly diluting shareholders just to keep the lights on. But Big Bear is sitting on a mountain of cash.
A literal fortress. As of September 30th, 2025, they were holding roughly $456 million in cash.
Let's just pause on that number. $456 million. Their whole market cap is what, $2.6 billion?
Around there, yeah. So they have this massive chunk of their entire company value just sitting there in liquidity.
That's a huge safety net. It means they don't have to go begging to Wall Street if the economy gets shaky.
Exactly. It gives them optionality. But the cash is only half the story. The other half is what happened just a week or so ago on January 16th. This was a critical event. They completed a redemption of about $125 million in notes.
Right, the debt. They basically wiped it all out.
Almost entirely. They took their debt load from $142 million down to about $17 million. A massive transformation.
Okay, so for the listener who isn't a CFO, why does converting debt matter so much?
Great question. Two main reasons. First, the interest drag. You're writing a check to the bank every quarter just for borrowing. That payment, it's gone now.
So that money stays in the company, can be used for R&D or hiring.
Right. Second, and maybe more importantly, is refinancing risk. If you have debt coming due in a high interest rate environment, you could go bankrupt. They eliminated that risk. Their debt-to-equity ratio is now tiny, around 0.18.
So they're essentially debt-free, sitting on nearly $500 million in cash.
They've shifted to a fully equity-funded model. They have that fortress balance sheet to fund operations for years. They aren't desperate.
Okay, so they have the money, they have the safety net, but what are they actually selling? Because everyone claims to be an AI company these days. What makes Big Bear different from just a wrapper around OpenAI? That is the multi-million-dollar question. The difference comes down to two words: decision dominance. Decision dominance. Sounds very military.
It is. And it has to be. You can't just take ChatGPT and plug it into the Pentagon's classified network. It doesn't work that way. Think about the security.
And the hallucination risks, right. You don't want an AI making up a threat when you're talking about troop deployments.
Exactly. It's a non-starter for the Department of Defense. This is where Big Bear has carved out its niche. And this is where their big acquisition of Ask Sage comes in. They spent $250 million on this.
That's a huge bet. What is Ask Sage?
It's a generative AI platform built from the ground up specifically for the defense and intelligence sectors. It's designed to handle classified workflows, to be auditable, to be secure.
So it's like a hardened military-grade ChatGPT.
In simple terms, yes. And who's using it? The Defense Health Agency, the U.S. Space Force. These are serious players who need AI but cannot use the commercial tools we use. This creates a massive moat.
A moat, meaning it's hard for competitors to cross.
Right. It takes years just to get the security clearances to even bid on these contracts. Big Bear and Ask Sage are already inside the building.
But it's not just spies and soldiers, right? I saw they have a deal with the Kraft Group.
This is what's so fascinating, because it proves the tech translates.
Right.
The Kraft Group and the New England Patriots are using it for supply chain transparency and fan engagement.
Wait, so the same tech that helps the Space Force is helping track paper products and football fans. How do those two connect?
It sounds wild, but at its core, it's all about processing complex, chaotic data and giving you a clear decision. Whether it's a satellite or a shipping container, the underlying brain is the same. The Kraft deal is so significant because it proves they aren't just a government contractor.
That's a big deal. It opens up the private sector. Okay, let's pivot to the charts. Looking at the price action, it's been, let's call it volatile.
Volatile is putting it politely. Yeah, the stock is trading right around the $6 mark.
And looking at the moving averages, it's technically in a bit of a slump.
It is. For the technical traders, it's sitting below both its 50-day and its 200-day moving averages, which is, typically a bearish signal.
But, and I know but I looked at the volume.
You have to look at the volume. We're seeing huge spikes on the down days. I mean, over 115 million shares trading hands.
Explain why that's significant. Shouldn't high volume on a down day be scary?
It can be, but often it signals capitulation. It's panic selling. The weak hands, the people who got scared by those revenue headlines, are dumping the stock. But the key is, for every seller, there's a buyer.
Someone with deep pockets is stepping in and saying, I'll take that off your hands at $6.
Exactly. The stock is coiling. It's building up energy before a potential move. It's often the final washout before a reversal.
And looking at the analyst community, there seems to be a huge disconnect.
It really is. The consensus is a boring hold with a $6 target. But then you have outliers. H.C. Wainwright has a buy with an $8 target. That's roughly 35% upside.
And I saw some quant models projecting it could go as high as 938 by year end. And here's the kicker, and this is one of my favorite metrics. Institutional ownership is incredibly low, only about 7.5%. Usually people say that's bad. It means the smart money isn't interested. What do you see it as a positive here?
Because it represents dry powder. Low institutional ownership in a turnaround play is bullish. It means the big players haven't arrived yet. If a big fund decides this is real and starts buying, They don't buy 100 shares. They buy millions.
Right, they can move the stock. You want to get in before the whales do. But we have to be responsible. What's the bear case? The bear case is real, and it focuses on three things: dilution, execution, and noise. Let's start with dilution. Remember that debt we celebrated getting rid of? The $125 million.
Right. It didn't just vanish. It was converted into equity. And shareholders voted to double the authorized shares to 1 billion.
Okay, so what does that do to my slice of the pie?
It gets smaller. The company is a pizza cut into 8 slices. You own one. Now they're cutting it into 16. You own a smaller percentage. That's the cost of fixing the balance sheet.
So my slice got smaller, but the pizza shop is less likely to burn down.
That's a colorful way to put it, but yes.
Huh.
The second risk is execution. This is the big one. They spent $250 million on Ask Sage. If they fail to integrate it, or if those government contracts get delayed, it's a disaster.
And government contracts are notoriously slow, glacially slow. And that brings us to the third risk, the legal noise. You might see headlines about law firms investigating securities fraud. I saw those. Investigation announced. It sounds terrifying.
It's mostly ambulance chasing. Whenever stock drops, these firms pop up hoping to get a class action suit going. It's usually just noise, but it scares retail investors.
And there was that downgrade from Cantor Fitzgerald.
There was, but keep in mind, that happened before the market fully appreciated the balance sheet cleanup. They were looking in the rearview mirror.
So, bringing it all together, fortress balance sheet, defense niche, but a messy chart and execution risk. What's the final verdict? Put a score on it.
If I'm scoring this as an investment opportunity right now, I'm giving it a 7.2 out of 10.
7.2. That's specific. Why not an 8?
Because this is a classic show-me story. It's a turnaround play. You are not buying it for the revenue growth today. You are buying it for the cash and the niche. The deduction is for that execution risk. They have to prove they can sell.
So what are we watching for? What are the catalysts?
The next 3 months are critical. First, Q4 earnings in late February. We need to see that revenue slide bottoming out. We don't need massive growth yet, but we need the bleeding to stop. But the real catalyst...
Contract wins.
Contract wins. We need press releases saying, Ask Sage wins X amount from the Army. We need validation for that $250 million purchase.
And the time frame. Is this a day trade?
Absolutely not. The volatility will chew you up. This is a 12 to 18-month hold through 2026. Entry in the $5.50 to $6 range looks like the floor. Exit target, you're looking for $8 plus.
So patience is key. You're buying the turnaround before it's obvious to everyone else.
Knowledge is wealth, but execution is everything. The debt is gone. The cash is there. Now management has no excuses. They have to sell.
That's the bottom line. The pressure is on. They've built the fortress. Now they need to defend the kingdom.
And maybe conquer a few new territories while they're at it.
Thanks for joining us on Smart Wealth with Joshua for this deep dive. Don't forget to subscribe and leave a comment with your thoughts on BigBear.ai. Are you buying the dip or staying on the sidelines?
See you next time.